Hi there, I'm Chris Rowe. I'm the founder and chief investment officer here at Avalon. And I'm here today because I want to help you maximize your retirement savings. Your 401k, 403b, or 457 plan might be the biggest, most important asset that you have to your name. It's the one that could have the most significant impact on your family's future wealth. Most investors don't have any idea just how easy it can be to add tens of thousands of dollars to their retirement savings with just 4 simple moves each year. And these types of retirement accounts, they have the highest growth potential because obviously these accounts grow on a tax-deferred basis. Most people know that. You're not paying taxes on the growth of the account each year. That obviously leaves more money available in the account to grow for years to come. And the compounding effect is enormous. And what I've said so far is not news to most people with these types of accounts. You already know that. Most people with these types of accounts are keenly aware of the enormous impact of not having to pull money out of the account to pay taxes on the profits in the account. They also know that accounts that are added to with pre-tax funds is also an immediate advantage. So far, so good. Sounds like it should be easy to build wealth with that advantage alone, right? But the major profits that are left on the table in these types of accounts actually comes down to something even simpler than just that. It's convenience versus complexity. You'd be surprised. When investors try to do this themselves, most of the time, they're just immediately turned off just by navigating the websites that they've been expected to use. So basically, they log on and they're asked, first of all, to choose from a limited list of funds that they don't understand. The funds sometimes even have wacky titles or a code that you're supposed to magically understand somehow. So the game is lost before it even begins. They develop this set it and forget it mindset. And when that happens, they never even get a chance to follow the strategy that I'm referring to. People are either too busy or they just can't be bothered to go onto the website to figure out how to manage this incredibly important and incredibly profitable asset. And without fiduciary requirements from brokers, investors have got to be extra careful who they entrust their future and their savings to. So you could be leaving a huge amount of money on the table without even realizing it. Maybe it's because you're trying to figure out which fund choices within your retirement plan are best to use, and maybe you decide that that's not a very good use of your time. And I get that. It can be overwhelming and intimidating and a turnoff. And I've heard it 100 times. They say, I know that I should look at my 401k, but I don't really know what I'm doing, and we don't get much help. Here's the reality of the situation. Most individual investors out there don't have a career that involves financial market analysis. They just don't. They've got families, they've got hobbies, they've got lives. They don't feel confident deciding how to position themselves without some help. The stakes are too high. And besides that, many investment professionals are not even good at managing money. They don't understand the financial markets, and they don't want to be bothered with these types of accounts. So what they do is they make up a legit sounding story on why they don't get involved at all. It's too easy to just leave it alone and focus on literally anything else. Some of the safest, strongest, and best performing investment strategies do require investors to get involved on some level, even if it's once a month or once a quarter. They do this to adapt and rebalance their investments based on market conditions, if they're doing it right. But the headache of navigating a website that you rarely visit and you're not very comfortable with using, just to make regular changes or to rebalance your account like a responsible investor should, keeps most investors from going in and actually doing the work. And I understand. The end result is that one of the easiest and most impactful strategies available to investors is rarely even taken advantage of. And that's crazy to me. Instead, investors are missing the chance to protect and grow their most important money, their most beneficial asset. When I say important money, I mean retirement money. This is literally the money that you need for medical expenses. It's the money that's going to help you live comfortably when you stop working, or it's the money that you're going to leave to your heirs. This is the money that sends you on vacations. This is the money that's going to let you see your family have time. It's going to get you the home that you want, or just get you out to the nicer restaurants. Some of you watching this may already be in your 70s or close to it or later. And after you turn 70 and a half, you must take the required minimum withdrawals from your 401k, unless you're still working, which may make you eligible for an exception. And if you're under 59 and a half and you take money out of most retirement plans, you end up getting penalized 10%. So whether you withdraw funds early and decide to accept that penalty, or if you wait until you can take it out penalty-free, or if you wait until you're required to take the money out after age 70 and a half, the question is still the same. It comes down to the same thing. Do you want to be the person who looks back years from now and says, if only I paid just a little bit of attention to this account once a month or even once a quarter, it could be several times bigger than it is today? Well, I'm here to tell you that you have two potential solutions to these problems. The first way to fix this is to take charge, get more involved in managing your account. It's not going to take a lot. Find and invest in resources that may give you the best chance of market-beating returns in your retirement plan accounts. Here at Avalon, we'll show you how to do that just in our free e-letter, Adapt. All you really need to do is take the time to learn a few of the investment strategies that are available to you and rebalance regularly, once a quarter or once a month. This includes the simple rebalancing strategy that I mentioned earlier that only requires you to look at your account 4 times a year. It's not that hard to do. I know it and you know it. But most people just can't or just don't do it for some reason. It has such a huge impact on your wealth. And that's not necessarily because it's difficult, it's because it requires time, and you just associate it with frustration. Let's face it, sometimes there's just not enough hours in the day. You might be busy, and you need discipline in order to do this regularly. And managing your emotions, let's face it, it can be a full-time job, especially when the financial markets are in chaos, which happens every 2 or 3 years. Plus, it takes more than just a basic understanding of the markets. Some people genuinely enjoy studying market behavior, but others don't. I mean, let's face it, most people don't. At Avalon, we refer to this as the 3 T's of investing: time, temperament, and talent. Do you have the time to actually go in and manage these investments? Do you have the focus and dedication? Do you have the temperament to keep your emotions in check when markets get scary and just continue to follow the process that you're following and you've been told outperforms markets? And do you have the talent, the resources, and the know-how to be able to manage what may be the biggest, most important asset that you own? So maybe you have the time and the talent, but you understand yourself enough to know that you don't have the right temperament to manage money through a variety of market conditions without panicking. I'm telling you, paper trading, a fictitious account, is very different from actually managing your money. Knowing what's going up or down is very different from actually managing your money, and that's okay. I've been investing money professionally for nearly 30 years, and I can tell you sometimes it's tough even for guys like me. All I ever do is study this stuff every single day. But if you can't bring all 3 T's together, you're not helping yourself. It's going to feel like you're driving over endless potholes. And just one of those potholes can be detrimental. Everything's going along smoothly until, bam, you drive over a pothole, you really feel it, it shakes you up, it affects your future decisions, and then it's smooth again, and then bam, and you hit the next one, and then the one after that. So it just continues. This probably sounds familiar to some of the people that are watching this right now. But here's a bit of good news that I have for you. You have a choice. Avalon is a registered investment advisor, and this means that we're also a fiduciary. We are required by law to put our clients' financial interests above even our own. We're not a stockbroker, we're not a financial consultant. We are the most fiduciarily aligned with you, the customer. So if you qualify, Avalon can rebalance your retirement accounts for you, and you don't have to do anything. We have very sophisticated tools that can analyze all the funds available to you, the mutual funds, the ETFs listed in your qualified plans, 401k, 403b, or 457. And we use these algorithms to identify the strongest funds available within your retirement plan, ranking the funds from strongest to weakest. So we customize it specifically for you. And the algorithm creates scores for the funds based on chart patterns, moving averages, momentum, and rankings for the funds versus several important market and peer groups over several time periods. This score uses proprietary weightings, and these weightings are designed to score a fund based on certain trends, while at the same time relative strength scores represent the remaining 2/3 of this algorithm, the remaining 2/3 of this score. The weightings of the score are 2/3 relative strength. The end result is we create a matrix of all of the available funds within your personal retirement account, ranked according to their relative strength when compared to one another. So basically, selecting from only the funds on the very top of the matrix list, the highest ranking funds, might give investors the best chance to outperform the market benchmarks. So I'll give you an example. Take this model by NASDAQ that uses fund score rankings. It ranks mutual funds, or ETFs, but in this case, it ranks mutual funds managed by the American Funds Group. American Funds is one of the most popular family of funds. The model stays invested in the top 2 ranked funds, of which I think there are about 25. And it rebalances just once per quarter based on the matrix results, based on the scores and the rankings. Sometimes growth funds are at the top, other times it might be income funds or even money market funds. Check out this chart. Look at the difference in results. The results of following this easy to implement strategy can be absolutely staggering. Look at the aqua colored line. A $10,000 hypothetical investment into the S&P 500 Total Return Index on December 31st, 1996, and held through May 25th, 2018, would have increased in value by 450%, or to $54,906. By making a hypothetical $10,000 investment on December 31st, 96, and letting it ride until May 25th, 2018 in a single fund, the investment grew by 797%, increasing in value to $89,731. Now, here's where things really get interesting. A savvy investor who invested that same hypothetical $10,000 in the model nearly tripled the value of the investment in the S&P 500 Total Return Index, gaining 1,505% and increasing in value to $160,000. The model nearly tripled the investment following the index and doubled the very successful Growth Fund of America. And let's pause here for a second. Keep in mind that we're comparing the performance of this relative strength model to the S&P 500 Total Return Index. The S&P 500 Total Return Index is not the same as the regular S&P 500 benchmark that everybody talks about. 90% of fund managers are unable to beat the benchmarks. That means if you're managing a stock portfolio of large cap stocks as a fund manager, 90% of you cannot outperform the S&P 500. Now, the S&P 500 Total Return Index performs much better than the S&P 500 itself because the total return version actually reinvests all the dividends paid out automatically, which makes the S&P 500 Total Return Index a much stronger index. So when we show that we're dramatically outperforming the S&P 500 Total Return Index, that means we're blowing away the regular S&P 500 index. Now, what's really amazing about this is that in our example, the model only required rebalancing less than 4 times a year over the last 21 years. That being said, you might be wondering if you should use a financial advisor to manage your 401k instead of handling it yourself. First off, financial advisors are experts when it comes to retirement planning and investing. They know all the ins and outs of the financial markets, and they can help you make smart decisions based on your goals and how much risk you're comfortable with. And that's the most important thing, is that you're comfortable so you don't end up being emotional and selling at the worst possible time. Let's face it, life can get really busy sometimes, and managing a 401k takes time and effort. When you only look at it sometimes, it can affect your emotions when things get shaken up. And if you'd rather spend your time doing other things that you love to do, an advisor can take care of all the monitoring, research, and analysis for you. It's a real time saver. The best part is, a good advisor will customize their advice to fit your unique financial situation and goals and your tolerance for volatility, so that your account's not all over the place, freaking you out all the time. Again, most important thing is that you're comfortable. So an advisor can create an investment plan that's just right for you. It's easy to get scared out there or excited during the market ups and downs. We all know that. But a financial advisor can help keep you on track, stick to your long-term plan so that you don't make hasty decisions that you might regret later. Let's face it, we don't panic and sell when things are going great. So we don't end up selling at the top out of emotion. It's only at bottoms. So diversification is a smart move when it comes to investing. And an advisor can help you build a well-diversified portfolio, spreading your risk across different types of investments. And that way, if one investment doesn't do so well, it won't hit you as hard. It won't be as volatile for you. Taxes can be a real headache, but advisors can help you figure out tax-efficient strategies so that you don't pay more than you need to on your hard-earned savings. And don't forget about all those rules and all those regulations that come with 401k plans. Advisors already know exactly how they can make sure that you can stay on the right side of the law. They know their stuff. Of course, not all advisors are created equal, right? We've seen some doozies out there. Everybody has, right? But their fees and their services can vary, and you have to be careful about that too. So it's essential to do some research, find somebody who you can trust, and make sure that they're looking out for you and your best interests, because that trickles down to the best interests of your family. An advisor can be a great partner to securing your financial future. So in closing, I'm going to leave you with one of my favorite quotes by Peter Lynch. Peter Lynch is a famous fund manager who had great success, long story short. He said, spend at least as much time researching a stock as you would choosing a refrigerator. Now, he's just talking about an individual stock there, but what he's saying basically is that how to invest your life savings is one of the most important decisions that you can possibly make. Therefore, it deserves some extra consideration and research. At Avalon, we aim to educate the public on our approach and how it's vastly different from what they're used to. I haven't seen anybody out there who's doing the same thing that we are, but we also ask that you take some time doing your own research. You didn't get to where you are by making poorly informed decisions, right? The reason you have this money in the first place is because you made some good decisions. So why not invest some of your time into understanding how to intelligently invest your money and finding out who the best partner is to do that? The world's changing quickly, money's evolving quickly, and investing methodologies are also becoming more and more sophisticated, but also more and more accessible to you. So it's time for you as an investor to raise your level of sophistication and take a look at what's out there. Invest with Avalon and become comfortable with your portfolio. If you have an investment portfolio worth north of $1 million or more, we'd love to talk to you about how we can help you better manage your account and we can manage the relationship. Or if you're currently working with an advisor who's managing $200,000 or more of your portfolio, just give us a call. We can link up with your advisor. We could set up a sub-advisory agreement. So we'll be managing some of that money or all of that money, and you could still have that relationship with your advisor that you're currently with. You can enjoy the benefits of investing with Avalon's proprietary investment models, while at the same time continuing to work with your trusted advisor. So everybody wins. We can schedule a free consultation with you with a risk management specialist here at Avalon by clicking on the link below or by visiting the scheduler on our website at avaloninvest.com/consultation. Again, that's avaloninvest.com/consultation. It has been my life's mission to make relative strength investing something that everybody knows about and everybody understands. It makes investing so easy. Even if we're doing it for you, if you understand it, then we can speak fluently with one another about your investments very, very easily. So keep your eyes on your inbox for your next issue of Adapt, which is our regular newsletter, and let the learning begin. Until then, take care, and thanks for tuning in. I hope to talk to you more soon.